one of the most important skills that you need as a trader is the ability to read the market structure. It is a critical skill that will allow you to use the right price action strategies in the right market condition. You are not going to trade all the markets the same way. You need to study how the markets move and how traders behave in the market. The market structure is the study of the market behavior, and if you can master this skill, whenever you open your chart, you will be able to answer these important questions. What the crowds are doing, who is in control of the market, buyers or sellers? What is the right time and place to enter or to exit the market, and when you need to stay away? Through your price action analysis, you will experience 3 types of markets: trending markets, ranging markets, and choppy markets. In this video, you will learn how to identify every market and how to trade it. To determine whether a market is trending or not, you have to use bigger time frames such as 4 hours, the daily or the weekly time frame. Never try to use smaller time frames to determine the market structure. Trending markets are simply characterized by a repeating pattern of higher highs and higher low in an uptrending market, and lower high and lower low in a downtrending market. Let's see an example of uptrending market. As you can see in the example, the market is making series of higher highs and higher lows, which indicates that the market is uptrending. You don't need indicators to decide if it is bullish or bearish. Just a visual observation of price action is quite enough to get an idea about the market trend. Let's see an example of downtrend market. The example above shows a bearish market. As you can see, there are series of higher lows and lower low, which indicate an obvious downtrend. Trending markets are easy to identify. Don't try to complicate your analysis. Use your brain and see what the market is doing. If it is doing series of higher highs and higher low, it is simply an uptrend market, and if it is making series of lower highs and lower low, it is obviously a downtrend market. How to trade trending markets? If you can identify a trending market, it will be easy for you to trade it. If it is a bullish market, you will look for a buying opportunity because you have to trade with the trend. And if the market is bearish, you have to look for a selling opportunity. But the question is, what is the right time to enter a trending market? Trending markets are characterized by 2 important moves. The first move is called the impulsive move, and the second one is called the retracement move. Let's see the example to understand what I am talking about. As you can see, the market is making higher highs and higher lows, which indicates a bullish market or uptrend market. If you see this market, you will think of buying. But as you can see, the market is making 2 different moves. The first move is an impulsive move, and the second one is a pullback or a retracement move. Professional traders understand how trending markets move. They always buy at the beginning of an impulsive move and take profits at the end of it. This is the reason why the market makes an impulsive move in the direction of the trend and retraces before it makes another impulsive move. If you are aware of how trending markets move, you will know that the best place to buy is at the beginning of an impulsive move. Traders who buy in uptrend market at the beginning of a retracement move, they got caught by professional traders, and they don't understand why the market is going against them. Let's see an example of a bearish trend. The given chart shows a downtrend market. As you can see, the best trading decision is to sell the market at the beginning of an impulsive move. If you try to sell in the retracement move, you will be trapped by professional traders and you will lose your trade. Now we know how to identify downtrends and uptrends, and how to differentiate between an impulsive move and a retracement move. But the most important question is how to identify the beginning of the impulsive move to enter the market in the right time with professional traders and avoid being trapped by the retracement move. To predict the beginning of the impulsive move in a trending market, you have to draw support and resistance levels. So now we will see what are support and resistance levels and how to draw them. Support and resistance are areas where buyers and sellers find some of equilibrium. They are major turning points in the market. Support and resistance levels are formed when price reverses and change direction, and price will often respect these support and resistance levels. In other words, they tend to contain price movement until price breaks through them. In trending markets, support and resistance are formed from swing points. In an uptrend, the previous swing point acts as a support level, and in a downtrend, the old swing point acts as a resistance level. The given chart shows how the previous swing point acts as a support level after the breakout. When the market makes the retracement move, it respects the previous swing point, which will represent the beginning of another impulsive move. As you can see, when the market tests the previous swing point, it goes up again. By drawing a support level in an uptrend market, we can predict when the next impulsive move will take place. Let's see an example of a downtrend market. The given chart shows us how the market respects resistance levels. When price approaches the previous swing point, the market makes an impulsive move. If you understand how price action acts in a trending market, you will predict with high accuracy when the next impulsive move will begin. Now learn how to draw trend lines. To draw a quality trend line, you will need to find at least two minimum swing points and simply connect them with each other. The levels must be clear. Don't try to force a trend line. Don't use smaller time frame to draw trend lines. Always use the 4 hours and the daily time frames to find obvious trend lines. We will try to focus right now on how to draw them in a trending markets. Our purpose is to identify the beginning of impulsive moves in a trending market. See an example of how to draw trend lines in a downtrend market. As you can see, the market respects the trend line, and whenever price touches it, the market reverses and continue in the same downward direction. When the market moves this way, trend lines help us to anticipate the next impulsive move with the direction of the market. Look at another example of an uptrend market. As you can see, the market respects the trend line, and by drawing it the right way, we can easily predict the next movement upward. This is all what we can say about trending markets. I think it's clear and simple. Now what I want you to do is to open your charts and try to find trending markets. Find previous swing points, support and resistance, and try to find trend lines as well. This exercise will help you understand how trending markets move and how to predict high probability entries in the market. Now we will see how to trade ranging market. Ranging markets are pretty straightforward. They are also called sideways markets because their neutral nature makes them appear to drift to the right horizontally. When the market makes a series of higher highs and higher lows, we can say that the market is trending up. But when it stops making these higher highs and higher lows, we can say that the market is ranging. A ranging market moves in a horizontal form, where buyers and sellers just keep knocking price back and forth between the support and the resistance level. Now let's see an example of ranging market. The chart above shows a ranging market. As you can see, the price is bouncing between horizontal support and resistance level. The difference between trending markets and ranging markets is that trending markets tend to move by forming a pattern of higher high and higher lows in case of an uptrend and higher low and lower low in case of a downtrend. But ranging markets tend to move horizontally between key support and resistance levels. Your understanding of the difference between the both markets will help you better use the right price action strategies in the right market conditions. Trading ranging markets is completely different from trading trending markets because when the market is ranging, it creates equilibrium, buyers are equal to sellers, and there is no one in control. The best buying and selling opportunities occur at key support and resistance levels. There are 3 ways to trade ranging markets. I am not going into details because what I want you to get here is the skill to look at your charts and decide whether the market is trending or ranging. I will give the trading tactics and strategies that you will use to trade trending or ranging markets. If you can't differentiate between ranging markets and trending markets, you will not know how to use these price action strategies. The first way to trade ranging markets is by waiting for price to approach support or resistance level, then you can buy at key support level and sell at key resistance level. Let's see an example. As you can see, the market is moving horizontally. In this case, the best buying opportunities occur at the support level, and the best selling opportunities occur at the resistance level. The second way of trading ranging markets is by waiting for the breakout from either the support level or the resistance level. The breakout means that the ranging period is over and the beginning of a new trend will take place. Let's see an example. As you can see, the market was trading between support and resistance levels, and suddenly the price broke out of the resistance level. This indicates that the beginning of a trend is likely to happen. So the best way to enter is after the breakout. The third way to trade ranging markets is to wait for a pullback after the breakout of the support or the resistance level. The pullback is another chance to join the trend for traders who didn't enter in the breakout. Let's see an example. As you can see in the chart above, the market was ranging. Price breaks out of the resistance level to indicate the end of the ranging period and the beginning of a new trend. After the breakout, the market comes back to retest the resistance level, and that becomes support before it goes up. But pullbacks don't always occur after every breakout. When it occurs, it represents a great opportunity with a good risk to reward ratio. If you miss the breakout, wait for the pullback. When it occurs, don't hesitate to enter the market. When you are trading ranging markets, always make sure that the market is worth trading. If you feel like you can't identify the boundaries, support and resistance, this is a clear indication of a choppy market. Choppy markets are those which have no clear directions. When you open your chart and you find a lot of noise, you can't even decide if the market is ranging or trending. This type of markets can make you feel very emotional and doubt your trading strategies. After some training, spending time on screen and experience, you will easily be able to identify if a market is ranging or it is a choppy market. Let's see an example of choppy market. Notice in the given chart, the price action in the highlighted area is very choppy, and it is moving sideways in a very small tight range. This is a sign of a choppy market that you should stay away from. If a market is choppy, in my opinion, it is not worth trading.